The NSO, the National Statistics Organization, has announced the third quarter GDP numbers. They have come in at 4.4% compared to a CNBC-TV18 poll of 4.7%. May look like a disappointment, but it is not. And it is not because the government has also revised the previous numbers. It was expected that the NSO would give the first revision of FY22 numbers, the second revised estimate of FY21 numbers, and the third and final revision of the FY20 numbers. Now, both FY21 and FY22 numbers have, for most quarters, been revised higher, including the third quarter. So, because the third quarter has been revised higher, the present third quarter of FY23 at 4.4 is actually good and in line with street expectations. In fact, maybe even a little better. The other important number that we should note is that the full year of last year, FY22, which was originally estimated at 8.7%, has now been revised higher to 9.1%. So that's a damn good number. Those are the details. For more, I spoke with experts, Aditi Nayar, the economist from ICRA, Kaushik Das, the chief economist from Deutsche Bank, Nikhil Gupta, the economist from Motilal Oswal, and of course, the former chief statistician and former chairman of Statistics Commission, Dr. Pronab Sen. Here's a slice of the chat I had with them. Financial sector is coming in at 5.8. Okay, I think that's also in line. And public administration, defense and other services has come in at just 2%. I don't think my poll gave such a low number. I think we had a slightly better number for public administration, if I can get it. I mean, we had expected something like 5%. So public administration clearly seems to be much lower. Okay, Aditi Nayar, on this, any comments?
Thanks, Lata. So definitely public administration is the main outlier compared to our forecast. We had placed that sector at 6%. So with that coming in at 2% only, that seems to be the main reason for the overall GVA number being below our expectation. And otherwise, I would say most of the industrial subsectors have done better than what we expected or in line. And agriculture has also been in line. We had penciled in 10% for trade, hotel, transport, communication. And I think the number that you mentioned was quite similar to that, as was the financial real estate subsector. So the other thing I'd like to point out is that this is a quarter where the GVA growth is actually higher than the GDP growth. And I think this is happening after a gap of at least a couple of quarters, where the wedge is negative between the two instead of quite substantially positive as we saw in the last couple of quarters. So I think that is also something that we need to delve into.
You're right. It's a 20 basis difference. GVA has grown 4.6. GDP is growing 4.4. Any reasons for that, Aditi?
So we'll have to just kind of think through why indirect taxes, less subsidies, effectively the net indirect tax number would have contracted in this quarter. Whether there has been a jump in subsidy release by Government of India and the states put together, or because indirect taxes, other than the contraction in excise, which is something that has persisted since March, at least the GST numbers have done very well for the center and for the states. And state revenue numbers, tax revenue numbers are quite okay. So that's not the reason for this.
Okay, I just want to add a bit more. All the previous GDP numbers for Q1 and Q2 have been revised higher. The previous unrevised number for second quarter was 38.16 lakh crore. Now we have a number of 38.81 lakh crore almost. So it's a fairly substantial revision higher of about 65,000 crore more that the nation seems to have produced in the second quarter. First quarter, again, the unrevised number was 36.85 lakh crore. It has been revised higher to 37.47 lakh crore. But even then, we are not getting a higher GDP number for the first quarter. First quarter, remember, we had 13.5. It is now 13.2. So clearly, Dr. Sen, your guess, the previous 21-22 has been revised much higher. And that's why in spite of a higher, aggregate number, we are getting a lower rate of growth. So there is a fairly substantial revision higher in the FY21-22, for which we are getting the first revised estimates. That much I can tell you, but let me get more thoughts. Kaushik Das, from what I have told you, any comments?
Lata, I think the broad story is that CSO has kept the FY23 growth number at 7%, despite FY22 being revised up to 9.1. Now, obviously, that could have come on the back of that minus 6.6 of FY21. We don't know whether that revision has happened. Obviously, some revision would have happened for 9.1 number to come in FY22. But the broad story is that they're still holding on to the 7% forecast. Whereas, RBI's number of 4.4 in October, December, that's exactly bang on target. But then they have a lower forecast of 4.2 for January, March. I think that number has to be higher if you have to tally up to, 7% growth. So overall, it looks like growth is still resilient, at least till October, December. If you take care of the, base that has been raised higher and still got 4.4, otherwise the number could have been higher. And the story that, nominal GDP growth has been 16% in FY23. Now, going forward, all those will not remain. The nominal GDP growth would be much lower. Sequentially, growth would be coming down. I think that would be the main focus. What we would also like to see, you haven't discussed the growth in consumption and investment, because I think CSO gives in the form of percentage of GDP. Yeah. If you can tell us what has been the growth of private consumption and investment, that would be helpful, because going forward, what would be more important is whether we are seeing private sector investing in fresh capex, and that is like 75% of total investment. That could, support the 6% growth that we are looking for in FY24.
Okay. I was coming to it. It's just that there is such a welter of confusion about the output division of GDP itself that I didn't come to the expenditure immediately. I can tell you this much. 1 minute. The private final consumption has come in at 24 lakh crore. Okay, that compares with 20. Okay, actually, private final consumption expenditure has not increased at all. It is 24.26 lakh crore year ago, third quarter. And I think that's a revision higher, because the original number was 23.3. The last year's number has been revised higher to 24.26 lakh crore. And now 24.77 lakh crore. Looks like there has been hardly any increase in private final consumption expenditure, Kaushik.
Yeah, so that will be a disappointment. Otherwise, we probably would have gone closer to 5%. That's what our forecast was. But in the bigger scheme of things, anything between 4.5 to 5, I think, is kind of well accepted. The number, there's a component called discrepancy. We don't even know what discrepancy is contributing or, subtracting from growth. So I'll not read too much into all this. At this point of time, market was worried whether it will be, if it was below 4, then it would have been a worry. If it was close to 5.5, 6, markets would have taken notice of this fact. Okay. Now, if you are between 4.5 to 5 and you're going to get 7 in FY23, I think the focus shifts more to FY24, and markets will not bother too much about this data. We'll focus more on the February inflation number, which will come out next.
Okay, your guess is very good, because the discrepancy number is an ugly 1,17,000 crore. So that's making nonsense of everything. The private final consumption has risen only by 2%. And gross fixed capital formation has risen by 8.2%. So clearly, this is an investment-led growth, this 4.4%. It's not a consumption-led growth. Nikhil Gupta, any thoughts so far?
Thank you, Lata. Yes, so Lata, as you mentioned, consumption growth was much weaker than at least what we expected. We were expecting consumption growth to be close to 6%. But we understand that the base has been revised upwards, because in absolute terms, we were expecting 24.83 lakh crore consumption. And I think you said that it is close to 24.77. So the growth is primarily much weaker than expected because the upward revision in the base. 4.4% overall GDP growth, I think it's broadly in line with the expectations. We were at 4.5%. The details are very different from what we were expecting in certain areas. But I think when we looked at the monthly numbers, even the RBI was at 4.4%, as you mentioned. And when we looked at all the monthly numbers which are available up to December, the feeling was that growth could be closer to 4.6, 4.7, and that is why your consensus was also showing 4.7% and slightly higher. Oh. So in that sense, I think that there is a little bit disappointment at 4.4% number. And if I understood you correctly, you said that Q3 of last year was actually revised down.
Revised up, revised up to 38.5 lakh crore. We were working with 38.16. It has been revised higher.
No, in terms of growth.
Yeah, in terms of growth, it has been revised to 5.2. That is correct. If you remember, last year we had 5.4. It's come down to 5.2.
Right. So many numbers within the real growth, real GDP is actually, we look at from the growth perspective rather than from the absolute numbers.
Yeah.
So on a lower base, a slightly lower than expected growth in Q3, I think is a little bit disappointment is how I would look at it. But there are a lot of other numbers that we must see. We must look at what is the nominal GDP growth, what is the savings rate that has been released for FY22.
Growth, like I told you, is 2.1%. And believe you me, the government final consumption expenditure is like minus 0.5. And it is only capital goods that's a very substantial 8.2% higher. Dr. Sen, any thoughts on this? I mean, this is coming as a surprise, isn't it?
It is coming as a surprise indeed. And maybe that's what is explaining the large discrepancy element. Because the discrepancy usually comes out of the, working out the GDP on the basis of how you break down the production side into capital and consumer goods and services. And then you're looking at what the breakup you're getting from the expenditure side, and the difference gives you the discrepancy. So there could be some problem that's cropping up in terms of the classification. So one will have to see that a lot more carefully. But unfortunately, what we don't know, I mean, look, the growth in capex is excellent. It's very good news. The point is that what I would really like to see is what's happening to household savings in physical assets.
Okay.
Whether that has gone up or not, because that really is the only indicator that we have of what's happening to the MSME sector.
So I'll come to the savings in a minute, because that'll mean turning the page, and I don't trust the internet so much over here. I'll first read out what I have in front of me. There are huge upward revisions to FY21, the big year of COVID, the Delta year. That year, there has been a good 20,000 crore revision for every quarter, 20 to 40,000 crore revision for Q1, Q2 and Q3. And therefore, the FY22 numbers are looking a little jaded, especially for the first quarter. You remember we had that fantastic, we had a 20.1% growth in the first quarter. Okay, actually that's revised even higher to now 21.6. The second quarter, we were working with 8.4. That has been revised higher to 9.1. So we are seeing a lot of upward revision in FY21 and FY22. Overall, it looks like the revision of growth is extremely positive, because I don't see even a single downward revision. Just about every number is a higher revision. The 5.2 Q3 that we were talking about, that also the aggregate is revised higher. The rate of growth is revised lower, because the year ago Q3, FY21 Q3 has been substantially revised higher by about 40,000 crores. The Q3 that we had was 36.26 for, I mean 2 years ago. It has been revised to 36.60. So almost a 34,000 crore upward revision. Because of that, the Q3 of last year looks, in terms of rate of growth, just 5.2. But the absolute number is still higher. So what we are seeing is a series of upward revisions, no matter which quarter you pick. Dr. Sen, anything you want to say about that?
Well, this is curious. I mean, it would have made sense to have done this at a slightly later stage, given the uncertainties that we are facing. That is when we actually put together the annual accounts. Then a lot of these revisions would make more sense, because it would be more contextual. But I suppose if new data has come in and they're integrating it, then I suppose the choice of timing is theirs.
Yeah, there is that. I don't see any savings data that has been given over here. This is more or less all output only. I assume that the savings data, gross domestic savings. Sir, sorry, sir?
It comes only with the annual estimate.
Yeah, it will come only on May 31st. So we will not be able to give you any further data on savings right now. I think those analyses will have to be done a little later. So I think we have to work with this much. There are 2 or 3 conclusions that I can draw. One, all the previous year revisions, FY21 and FY22, have been revisions higher. I can't see any revisions lower. As for the current year itself, the current quarter itself, the 4.4% could look like a disappointment, but the disappointment is mitigated because it is coming on top of a revised higher base. A third conclusion is that consumption, both government and personal final consumption, are pathetic. What saved the day appears to be the capital expansion, the gross fixed capital formation. And maybe to make nonsense of everything that I said so far, there is a discrepancy number which is 1.1 lakh crore. So there are going to be a lot of revisions as those discrepancies get resolved. Okay, I think we have to come to final comments from all of you. Let me start with you, Nikhil. Last thoughts?
So Lata, as I said, it's a little slightly disappointed number, but I think Q4, we could be slightly above 4.5%. So for the full year, it could be 4.5 to 5% for Q4, going by the numbers that we have got for January. So for full year, we expect it to be close to 6.9% or so, which is in line with what the RBI or the government
what the CSO is saying. That's correct. That's correct. Aditi, any comments from what we have heard so far?
So Lata, to meet the 7% for the full year, our backward calculation is that Q4 needs to be slightly higher than 5%. So that's something now we need to look through all the revised numbers for the last 3 quarters and the high frequencies coming in for the current quarter to understand whether 5% is doable or not. And January numbers are good, of course, on the Omicron base. So that may be a little bit misleading. So we'll have to see whether that much of an uptick between Q3 and Q4 is likely to actually be able to meet the 7% full year number based on the revised data which has come out today.
Okay. Okay. Well, Dr. Sen, to you, sir, any final thoughts on the numbers? 4.4 looking disappointing, government final consumption expenditure going into negative. Any thoughts on any of the numbers?
No, I mean, again, I think 4.4 is more or less where I think most of us were at. I was pretty much there on that. That's not really the issue.
Okay.
The issue is the weakness in consumption.
Yes.
And particularly government expenditure. Some of that we had expected because the government was starting to taper down its consumption figures anyway. So that is not unexpected. The real question is private consumption. You know, what's going on there?
Okay.
From I think last quarter it was something like 9%.
Yeah.
And then that coming down to just 2% is really quite shocking.
Okay. Okay. So maybe that might start telling on the extent of the speed of growth in the days to come if consumption doesn't pick up. I guess that is a worry. But let's hope that the higher capital output is going to higher capital formation will give us higher productivity. We'll have to wait and see. Kaushik Das, I know it's a medley of numbers, but your final thoughts.
So Lata, if you want to see the positive side, given the last 2 years that it has been revised up,
higher.
We should be more revised higher. We should be hopeful that this number will also be probably revised higher, 7%. Okay. That's the positive way of looking at it. If you want to look at the negative story, private consumption at 2%, RBI has increased rates quite aggressively. If you are forward looking on monetary policy, then how much rate hike should you do? If you take this number at face value, should you be concerned because private consumption contributes almost 60% to GDP, and we know that rates will remain higher for longer, liquidity will tighten. So what would be the growth projection going forward for FY24 is what I'll worry about looking at this private consumption number, unless it's a one-off and it will be adjusted, discrepancies will be adjusted somewhere, and you'll not get a number 2% when the revisions happen. So, a lot of ways to look at it, but the broad story is 7% growth remains intact from CSO for FY23, and then FY24, we are at 6%. I think that number is still achievable.
Okay. Well, gentlemen and Aditi, thank you very much indeed for making sense of the numbers. My apologies, I didn't make this shifting sands. That's what we are getting from the huge number of revisions. But I think the key takeaways, if I can try and summarize, the overall NSO number of 7% for the year is good, especially because the previous 2 years have been revised higher. Over a 9.1%, if the NSO still expects a 7%, we shouldn't be terribly disappointed. That is why the 4.4% for Q3 itself, while it is lower than our poll, it should not be considered a disappointment. It should be considered in line, and maybe the overall numbers even better. The negative in the whole thing is what Kaushik and Dr. Sen have put in very ably. The consumption number is extremely troubling. Only 2% growth in personal consumption and a slight negative in government final consumption in the third quarter could be worrying. It's made up by an excellent capital formation number of 8.2%. Maybe some of this will be revised, but it will be a matter of worry if consumption is so low, whether we will be able to grow at the same pace our output in the coming year. That's the red flag, but the positive is that the previous numbers have all been revised higher. That's a positive. With that, we wrap up this special broadcast on the state of the economy. Stay with us for more news and updates follow.